If you're tired of losing money and always finding yourself on the wrong side of the market, I suggest you stick around throughout this video because I'm about to share the same exact techniques that I've used to find myself high quality trades and always find myself on the right side of the market. So without wasting more time, let's get into it. This is the last thing that we had looked at in the previous videos, and if you're not familiar with this diagram, I suggest you go and check out the previous videos. So today we're going to look at something a lot more difficult if you didn't master these first concepts: market structure, basic market structure, and then the advanced market structure, as you can see it on your screen right now. So I suggest from this point, if you haven't got well familiar with these diagrams, you should go and try to look through the previous videos. Okay, so I think that everyone watching this video right now is already familiar with these diagrams, because we're just going to add on from this. We are not going back behind, we're just going to add on from these diagrams. So today we're going to look at multi-time-frame market structure, and it's going to be so confusing if you do not understand the basic market structure and the advanced market structure. Previously we had looked at market structure alone, and then we looked at advanced market structure, and now we are going to continue to look at multi-time frame market structure. This simply means we are going to be dealing with more than one market structure at a go to look for a single move in the market. And as you've seen in the previous videos, we are always looking for that impulsive move, these impulsive moves. A brief recap: we always have this impulsive move that's going to lead to a pullback, that's going to lead to an impulsive move, that's going to lead to a pullback, that will later on give us an impulsive move. So looking at the market here and how it is, we expect a pullback before we have another impulsive move. So this is what we are always targeting, this impulsive move. We get it here the week and we ride it to the upside. Simple stuff. So let's look at ways we can do that. So first we have to first observe market structure as it is. So looking at market structure here, it clearly shows that we are in an uptrend. Of course, as you can see, we have bullish momentum. The order flow is to the upside as we are seeing these stronger lows continuously breaking the highs. So what do we anticipate here coming next? A pullback that will later on respect this strong low and push to the upside. That's all what we want. But how are we going to get this low? So we are going through these concepts of how we can get this next impulsive move. So today we are looking at the basic market structure, and we are going to add in another market structure. As I've told you, we are going to be dealing with two different types of market structures. In this case, we are going to look at a higher time frame market structure, which this is the short form of high time frame market structure, and then we are going to combine in a lower time frame market structure. Okay, so let me first put this here. So in the previous videos we only looked at market structure as one thing, and now we are going to combine the two. We are going to look at two different market structures combined together and how we can analyze them to get that next impulsive move, sharp entries. Okay, so high time frame market structure, and then we're going to also add in the lower time frame market structure. simple stuff. High time frame and then low time frame market structure. So right now here on your screen we have the high time frame market structure. Let me say my higher time frame is H4. So if my H4 is looking like this, clearly bullish as you can see, and I'm expecting a pullback before the next impulsive move, then how do I use this type of market structure to my advantage? First, I can look for shorts in here because I already expect this pullback to come in till at least anywhere below my 50% of my Fibonacci. And if I get my Fibonacci, put it here, then I think I'll have to see the market go below here. Let me first put these off. So for me to get the next move, or for me to buy again, I'll be looking to first see if the market is going to go below my 50%. Then in around here I'll be looking for a buy to get hold of this next impulsive move. Simple as possible. We are just going to combine two time frames. You can use 3, you can use 4, but the most simplest way or the best way is to use two time frames. Two time frames, and then we can analyze their market structure and then put it together to come up with something that's going to help us to determine the next impulsive move. Okay, so HTF is just a simple abbreviation for high time frame market structure, and then we also have LTF, which stands for lower time frame market structure. So right here we are looking at the higher time frame market structure. So your higher time frame market structure can be anything you consider to be high. For me, it's always my H4. Yeah, my 4 hour is always my high time frame market structure, and then anything below that is always my low time frame market structure. Okay, so here, so this is our high time frame market structure, and what do we use this for? I always look at my higher time frame market structure just to anticipate where the market is going, then I can use that to my advantage before it does that. So I always use my higher time frame to just get the narrative. I don't trade on H4. I use this for my narrative, just to get the story of what I should expect. So looking here on my H4, if I've had these highs being broken each time the market came down, look, we have this low, this high gave us a pullback, giving us a low, and later took out the high. So now here we have the BOS, and we shall always trade in that direction of BOS. So what do I do next? I look for this trade and then I take it to the upside, and if we break here, then I look for the low. Once I notice where the low is, it should give me a break of structure. Once I see the break of structure, then what should I expect? To find out what I should expect, I just look previously here. After I had this impulsive move, low, we broke structure. Then what did I want to expect? A pullback. It's already here, happened. Then what did I expect after the pullback? Imprint of a new low, and then we shoot to the upside with an impulsive move. So looking at market here, I expect another pullback coming into my discounted zones before the next move. As simple as that. So what do I do in order for me to get this move here, to ride along with the move? I'll look at my market structure and understand where I should be looking at. Okay, so let me first put this off. Yeah, so how exactly do I look at this market structure? First things first, Fibonacci. You want to look at your Fibonacci, and you want to get anything below 50%. So I'll be looking for buys when I see the market below my 50% here. Okay, simple stuff. This is my premium zones. I can't look for buys here, but I'll be happy to buy when the market gets to my discounted zones. But this is the higher time frame, so it's just giving me a narrative. So what narrative do I have here? I expect the market at least to drop below 50%. So just having this in mind, that's a trade on my lower time frame. I won't trade on this higher time frame, but on my lower time frame I already have a trade just by anticipating this, the move on the higher time frame. So this is my narrative. I think the market would want to come back below and then we can shoot up, hence giving us another break of structure. So how many trades do I have here? Because I normally trade on my lower time frames, so I have a sell and I'll also have a buy. 2 trades from this narrative I'm having on my higher time frame. So since the market has just given me a break of structure and I'm not seeing anything else, I'll wait for the market to give me any sign of coming back down so that I can ride along this move that's going down, and then I can also try to target this move that will shoot up. Your points, as you can see. So I want to understand, using the previous concepts that we used, I want to understand which point is stronger than the other. So looking at this high, it was clearly taken out, which means this high was weak and my strong point was just here, and then this strong point put on a new high, which later on gave us a new low, which later on gave us another break of structure, meaning it took out this. So my recent strong point is just right here. And remember, we always trade in the direction of boss, so my recent boss is here. So where is my recent trading range? Yeah, I told you we mark from the what, from the strong point to the point that was taken out. Okay, so okay, this point was taken out. We want to look for a new point here that we can mark. Maybe let me say we anticipate the market will end somewhere there. Let me continue this with another arrow, and then we want to anticipate another move that might happen like this, and will later on give us another break of structure to the upside. So let me make this dotted so that you can see that this is just an anticipation. It hasn't happened yet, but that's how we hope the market should happen. So looking at this here, like I told you, so this is how I mark my trading range. Yeah, for you to mark your trading range, you need to first see that new high in place. So maybe you should be marking this high and the low once the market is somewhere in around here. You mark that, and then you know that you're going to be trading this bullish trading range. Why is this bullish? We are following the side of the BOS, the break of structure. So after seeing this break of structure, then we want to ride this momentum still in this protected low. Why is it protected? Because whoever entered here with more money to take out this high, he has to protect his money. He won't let the market go below his positions, because if they go below his positions, that means he will end up in negatives, and we are all in the business to make money. So I don't think that whoever entered here with more money can leave these trades to go below him. Okay, so in theory this is a protected low, and we hope that when the market gets here, it will just respect this and then make a U-turn from in around here, giving us another push to the upside that will later on break structure. Simple stuff. So that's just my anticipation on my higher time frame. So I told you I use my higher time frame to just have the narrative of what I should expect. But when I go to my lower time frame, everything changes. I'll be explaining more about that when we get to the lower time frame. But I need you to first understand the higher time frame structure as we've seen it. Mark your trading range before you go down. Many of you make mistakes here, like after marking your structure points, you don't consider your trading range and you just drop down to a lower time frame where you're going to be squished, like you'll be crushed in between because you don't know what you should be expecting. But after you marking your trading range, then you know clearly that I have to see a pullback coming below my 50% before I should be buying, rather than just buying from in around here. Okay. Ladies and gentlemen, so here we have started with this statement. Okay, so as I told you, we're going to be looking at multi-time frame analysis, multi-time frame market structure analysis. In that, we are going to be considering different two time frames with their market structures all put together to find one sure, one high probability trade set up. So I have here a rule of thumb that I always follow, which states that a run on a higher time frame is always a trend on the lower time frame. Let's read this again. A run on the higher time frame is a trend on the lower time frame. So considering this black line to be our higher time frame and the red line to be our lower time frame, in most of the cases I use H4 to be my higher time frame and M15 to be my lower time frame. So looking at this example here, if we were to consider this rule of thumbs, then we should be considering this run. This is a run to the upside on the higher time frame, but at full trend on the lower time frame. As you can see, we have one single move on the higher time frame on H4, but very many moves down on the lower time frame, as you can see. So a run on the higher time frame is a trend on the lower time frame. That's it, as simple as that. And when we have the pullback, the same thing happens. It's also a run, but it's a full trade on M15. It's a run on H4, but a full trend on M15. The same happens. You see, the same happens here, and the same will also happen here, as you can see, and the same will also happen here. So what do you learn from this kind of analysis? So this kind of analysis, for me, I can say that the lower time frame is always following the H4. Okay, the lower time frame is always following H4. In which way? Because if you can see clearly here, whenever we have a run on H4, M15, it will be a trend on M15 that's following the same direction. As you can see, it will be M15 following the same direction. So ladies and gentlemen, here we are again. Now that you've tried to grasp the concepts, it's very simple, as you can see. Just that we added on another time frame to maximize our analysis. So we are trying to anticipate the next move here, which would happen like this, something like this. That's what we expect. So how are we going to finally get this? First, I'll need to take my Fibonacci out. This is a modified Fibonacci, and if you want to know how to get this Fibonacci, give me a comment down below in the comment section, and I'll be able to tell you how. And for any other question that you need to ask, you can simply type it down in the comment section and I'll be able to answer it in the next video. So this is how I'm looking to get the next move. But as I told you, I don't trade on the higher time frame, and right now we are looking at the higher time frame. I normally take my trades on the lower time frame, which is this red line, this inside red line. Okay, so we are just anticipating the higher time frame moves. As I told you, we use the higher time frame for narratives, but the lower time frame, that's our immediate bias. So that means we shall be looking for trades on the red line, this red line, yeah, M15, not the H4. Okay, so this is how I'm looking to get a trade, or this is how I'm looking to get involved. I'll be looking to buy here, or I can look for sales here. How am I going to exactly get sales here? As I told you, we looked previously here. How did this market have the pullback? Simply by having the choke on M15. You see that? After having the choke on M15, what happened? The pullback started. Simple stuff. And how did we know that the pullback was done? Simply by following the choke on M15. Simple stuff. After the choke on M15, the market had to put on the next impulsive move. Okay, simple stuff. So right now here, I'll be looking to first see something like a choke. Choke on M15 in order for me to look for any shorts. Once I see this choke on M15, then I know that the H4 pullback has started, and I'm looking for shorts to run till way down here below the 50% of my Fibonacci. And once I hit my 50% of my Fibonacci, I'm out. That means I'll only be trading this section here, from here to here, looking for sales from here to here. Once I get to my 50%, I'm out. Why am I out? Because remember, the structure is completely bullish. So you never know, it might just come here and then shoot to the upside. That means if you sold in around here, you're going to be taken out real quick. So I don't want that move to find me in. So once I see my choke on M15, then I anticipate that the H4 pullback has started, and I'll be looking for entries. I'll be looking for entries, specific entries. So this is not how exactly we look for entries. We add on some other concepts that are limited to our premium members. And if you want to join our group, then you should comment down in the comment section, or I'll be dropping my contacts real quick after the video so that we can get in touch. Alright, so I'll be looking to sell here and then target the 50% of my Fibonacci. After that, I'll be looking for buys. Anything below the 50%, I'll be looking for buys. I'll try to look for buys here to shoot to the upside. Why am I looking for buys here? We have a strong point. In theory, this strong point will always be protected. So whoever bought here to put on this impulsive move can't let his positions to get in negatives. Once the market goes below this, that means he's in negatives, so he won't let that happen if he really cares about his money. So we want to go with him when he puts in more money in around here to put on the next high to take out the previous high. Simple stuff.